evening. This is Jeff Scott. It is Saturday. It's a little bit after 11 p.m., so obviously the futures are currently closed. And this is the first of what will be a three-part weekend presentation. Actually, the weekend here extending to Tuesday. For those who haven't been here before, welcome. I put my, now that I've left work, I'm going to move to this email address, although the other one still works. If you need to contact me, Jeffrey at highgrowthstock.com. And what today is going to be is the tools of the trade, looking at different tools that I use. So if you've been on these webinars 100 times or one time, and you feel like you got it down as to what I do, and you don't have any technique questions, then skip this one and come back tomorrow and watch the regular video. But if you're new to HGSI, I thought I'd spend the next hour reviewing sort of the things that we look for, some of the indicators that we use, and then hopefully tomorrow when I do my top-down review, you'll get a handle of what we do. And then come Tuesday when I do the live meeting, if you have any questions, we'll be able to answer them for you. So without further ado, let's go ahead and let's get started. So as I said, this is a three-part, which I'm calling the Now That I'm Bored in Retirement series. Part one will be basics. Again, this is designed for those new to HGSI or wanting a refresher of the different indicators that we use. Number two will be, part two will be tomorrow for the tools to use, which would be my standard 1 hour top-down investment weekend review. Because I am doing this thing tonight, I'm going to spend very little time talking about where the indicators come from and get just into how I use them and finding the right stocks to buy. And then Tuesday at 2 p.m., I'll go live, look at the market, and we'll be able to answer questions as we take a look at the status of the market and whether or not there's some imminent or existing changes. The disclaimer, as always, this is for educational purposes only. I'm a doctor, not a broker. More comments about that later. And although I have a very close relationship with highgrowthstock.com and am clearly a big fan, I am currently independent. I do not own any software companies, and I have used I paid for all the tools that I use. So my background, for those who don't know me, I love sales and business. However, as that line says, I was born to a Jewish mother and a Jewish father, so I had to go to med school first. I built a large independent practice in Georgia. When I left, we had 47 docs and 27 offices. I have a tendency to get bored, and I started with a couple of great partners, a series of healthcare services companies, sold 2 to AmerisourceBergen and 1 to Cardinal, and I retired, at least for now, June 30th, so a couple months back, and or 6 weeks back. It seems like a long time, and I'll probably do some consulting, but for the most part, I want to trade for a living. And just so you know, I've been trading for a long time, and I started in the early 90s, like many other physicians, sitting at the doctor's lounge, watching CNBC, everybody showing off that they knew more, and then buying stocks that promptly plummeted after taking tips in the lounge. I started using a program early on called Telescan and another one called AIQ, and I met whom I consider to be a genius in this industry, Ian Woodward, who you'll hear about as I go through my presentation. So I do have a fairly large portfolio. I have multiple accounts, and I do segregate them in my mind. Some are more long-term, others are more actively traded. If someone asks how I trade and what my time frame is, I would say for the most part I swing trade. I have trades that last a couple of weeks, but some, such as the Celgene trade that I put on, gosh, almost 18 months ago, the Gilead trade, last a lot longer, and I may give them more room to run. Now, I've started, because I sit at home all day now, to day trade futures and their derivatives. I don't get why I would want to day trade stocks because of the liquidity of the E-minis and the NASDAQ futures, et cetera. And when I trade those, it's a whole different program. It's purely technical and it's fairly automated. I joke with my friends that the only time I day trade stocks is when I buy something on a swing trade and before the market closes, it took out my stop. It doesn't happen often, but when it happens, it happens. And I go on to fight another day. Sometimes I buy the same stock back the next day at higher than I got stopped out. When I trade, I'm really addicted to two things. I'm addicted to pullbacks and uptrends. So that really is my favorite type of a setup. So a stock that's been going up for some time pulls back to a major moving average or some other support, and then I see a momentum indicator coming in. That's what I look for. And I grew up listening to Kramer, and Kramer talking about how he would pay a price to earnings multiple up to 2 times the growth rates. And I decided I don't want to be so generous, and I'm going to try and find stocks who trade much closer to 1-to-1 or even better, stocks whose growth rates exceed their price to earnings multiple. Now, I've also learned that there are certain categories of stocks, the metals for some, oil, where their PEs as a group bear little reflection to their growth rates. And so you have to learn those and not look at just earnings per share growth and get out of control. Now, once I find a stock that meets my criteria for a setup, as I mentioned, I look for specific momentum indicators, and to me, that's one of the real strengths of HGSI. When I place my trade, I know my target and my stop, and I have it hidden in my desktop, so I think it's fair to say you'll eventually see it, that I own and have tried almost every software program on the market. I don't think I have analysis paralysis, but I certainly spent a lot of money on programs that I don't use. Now, my weekend review is called top-down investing. Top-down means that I'm recognizing that the majority of the move in my stock tomorrow is going to be related to the market, 50 to 70%. The next piece I want to look at is a sector and industry, which might be another 20% to 30%. And then I recognize that that stock may be as little as 10 to 20%. So if I'm a top-down investor, what matters is the market and the sector, and the stock is much less important. And that's how I do most of my trading, is I want to see where the strength is in the market. Now, I like to find wolf packs, which would be defined as a group of stocks in a similar industry breaking out at the same time. And that's further validation, as we saw the last 10 days perhaps with gold and silver making a nice move, that there's a change in the market sentiment or the likelihood of my stock performing. Now, a lot of people, and I have to admit I'm there as well, also do bottoms-up trading. Now, even in a bad market, in a bad sector, there are going to be leaders. A limitation of top-down investing might be that I limit myself to 10 or so industry groups out of the 140, 150 in HGSI because I only want to look at the best. A bottoms-up approach fishes from the entire 7,000 to 8,000 basket. I do believe that the bottoms-up approach allows me to catch movement earlier. And interesting to me, although maybe not surprising, that I often find the same stocks. And that would make sense because the best stocks are still going to be dependent often on their group and the market. The problem with bottoms-up investing or finding a stock who's trying to go up when the market and its sector is going down is that there's a much higher risk of failure. So I find that top-down analysis gives me my best chance of success, but I do supplement it with a couple of different searches that I'll show you today, or at least define what they are and show you how I do them, that broaden out my potential list of stocks to acquire. As I mentioned, I have a ton of stuff on my desktop, and as much as I'd like to say that I used every program I've ever bought, and of course, you know, I tell that to my wife whenever she sees what I'm doing, that's not the case. And frankly, if I was just starting out today and knew what I knew today, I'd have a whole different approach. I need a real-time charting and trading platform, and I've used TradeStation for a long time. I've got a lot of automation built into TradeStation, and I'll probably be stuck with TradeStation, which really pisses me off using vernacular of my son's generation, because I have to pay for TradeStation. On the other hand, Thinkorswim, which is a great product, I get free from TD Ameritrade. I don't pay for news. I don't pay for quotes. The advantage of TradeStation probably is mostly related to the fact that it's been around a long time and that you have a whole community of folks creating code, some of it which is available for free and much of it that I paid for. And I've got thousands of dollars invested in TradeStation programs, indicators, many of which I don't use anymore. And it'd be hard-pressed for me to move away from TradeStation. I will tell you that I'm getting increasingly interested in NinjaTrader. NinjaTrader is a platform that I bought. You can use it for free, but if you want to trade directly through it, then you need to purchase it. And a lot of the companies that have spent years working on TradeStation have moved into NinjaTrader as well. Now, during the market, most of what I need to do, I do within Thinkorswim during the days of the market or in TradeStation. However, at night when I want to do my analysis, I found that I do much better when I use HGSI, EdgeRater for both market timing and testing things that I do, ETF Bandit, a relatively low-priced tool that duplicates a lot of Larry Connor's ETF trading and has a great feature that allows you at 3:30 or 3 or whatever you want to do a update of the current prices on the ETFs. And following Connor's criteria that have been well defined and published, it will tell you before the market closes, or if you do it end of day, at end of day, what to buy and sell the next day. I'm also a fan of seasonal analysis, and you know, I couldn't tell in the beginning whether it was voodoo or make-believe. But if you think about seasonals, we all know that the sell in May and go away phenomenon, that's a seasonal phenomenon. We know about the president's cycle. That's a seasonal phenomenon. We know that the cycle of refiners, when they switch from winter fuel to summer fuel, has recurrent, repeatable changes. We know that the fertilizer stocks move at certain times of the year. Even gold moves at different times of the year. So why would it surprise anybody that stocks, which are part of many of those sectors, have seasonality? Now, I haven't convinced myself that seasonality trumps the rest of my analysis, but I do think seasonality is important. And I will scan for seasonality and then look at stocks that, again, this is more bottoms up, that might meet my criteria. But often what I'll do is I'll validate and check on stocks that I'm thinking about buying or selling and making sure that the direction I'm going is consistent with the traditional seasonality. I have also increasingly of late started using MarketSmith. I use it for a number of factors. I use it for its earnings analysis. And I use it also because it does a lot of automated pattern analysis. And if you have it, you see the colors that print at the far right of a chart, in a chart that's setting up in a base, in a cup, or whatever setup. And it does help me, guide me in finding those stocks, but also in helping to validate the right time to buy and sell them. So what I just defined, and I would say seasonal analysis, my favorite programs are Magenta 2 Invest Choice. That's it. I don't need anything else, and I've got a lot more on my desktop, as you'll see. The other thing that I need to take with me on my desert isle that has high-speed internet, of course, many of them do, I'm sure, is I have is a philosophy and an approach to trading. And what I do is what I learned from my gurus. Now, I mentioned Ian Woodward's name a while ago. And John Bollinger in a Stocks and Commodities Stocks and Commodities interview maybe a year ago called Ian one of the greatest analysts of our time. So one of the first things that Ian told me in the early 90s, this is Ian here, in his British accent, "Jeff, I'm not a guru. I will teach you to be your own guru." And that's what you want. You don't want me telling you what stocks to buy. You don't want Ian telling you what stocks to buy. You don't want Alexander Elder telling you what stocks to buy. What you want is to learn from people that you respect, that you think are knowledgeable, and then incorporate them in your own trading plan and your trading style. And I show this slide all the time because these are the folks that have helped me make a lot of money. Ian Woodward and Ron Brown on the right here are the heart and soul of high-growth stock investing, and we'll talk more about them later. William O'Neill has a very similar philosophy to Ian, and I think, truth be told, Ian learned much of what he has today from listening to O'Neill on the radio a long time ago. How to Make Money in Stocks, which may be into a further edition than this, I think this is the last edition, is the Bible. It is a great book. If you're learning to trade, if you currently trade, you need to read that book. I reread it at least annually, and I refer to certain parts of it on a more frequent basis. In fact, I just got it on my Kindle now, so it makes it easier. Morales and Katcher. I have to admit, and I think I've told it to Gil to his face, I looked at the book the first time and I put it back in the rack. I thought it was a little bit out there to say how we made 18,000% in the stock market. Well, I've got to know these guys, and I've read both their books, and then what you realize is they really did. And they just show how they applied O'Neill's discipline to their trading, but they also have their own special sauce and Bible gap-ups, pocket pivots, and things that I'll mention later today. They've become an important characteristic of my trading. Pasquale Lane, it's actually very mathematical, his book, but it's a pretty good read. He talks about effective volume and the tools that he's used to help separate, sorry about that, I almost spilled my coffee in my computer, to separate the large institutional trades from those of the small investor. And he has strong arguments that I would agree with, that stock price and change is often driven not by people like me that are buying small amounts of shares, but rather by the big institutions. I've actually subscribed to some tools from a company called Never Lost Trading that has their own unique indicators that look for specifically institutional footprints. Van Tharp has a series of books, giant books, that are really good about position sizing and money management. Up here in the upper right are Alexander Elder's books, and I've had the luxury of listening live to Dr. Elder, Ian, Ron, Gil Morales, and Chris Katcher. And I'm a big fan of going to live meetings because I spend 1 to 3 days concentrating on a specific discipline, and I always learn from that. Stephen Bigelow is my favorite candlestick guru. There's plenty others out there. Steve Nissen. And then Ronald Grunke, he's got some really interesting books, and his writing style is kind of more like a simple novel. And I've learned a lot from him, and especially now as I go into this set of my life, where my wife's wondering where the paycheck's coming from, and he makes paychecks by drawing about 10% every 6 months off of his portfolio by writing covered calls and naked puts. number of the websites are listed there. All these books, maybe not Pascal, that's probably the challenging read of the bunch, and Van Tharp's is a long read, I think are all important books, and I'm sure everybody has their own favorites. But when I talk about what I do, these are the influencers, among many others, but these are the major ones that have helped to drive my behaviors. Everything that I do when I look at stocks as a top-down investor are dictated by the current cycle in the market. I was actually doing an analysis looking at the S&P 500, also looking at the stocks that I often trade. And one of the early things that Ian taught us is that high growth stocks go up like rockets and fall like rocks. I looked at a portfolio of high growth stocks. I wish it was my own portfolio. Many of them were in my portfolio, but I had some other things there as well to kill it, or not kill it, but to reduce it. But a portfolio of high growth stocks that I watched from the middle of November until now are up over 85%. Again, I own many of those, if not most of them. But I do, unfortunately, it's a modest part of my portfolio. During that time that they're up 85%, the S&P 500, I don't think I call it regular stocks, are up about 28%. What I thought was most interesting was when I looked at the most recent 7.7, 8% decline in the market, which occurred about a month and a half ago. The S&P 500 was down, I think, 7.7, and that same basket of high growth stocks were down 28%. So the message there is they do go up like rockets and they do fall like boulders. So you need to know what stage the market is in, the sector, and the stock before you make a purchase. We want to be buying down on that green circle as it begins to be priced up. We want to be selling when the stock starts to roll over and becomes discounted. Greed is when we buy, and fear will drive prices down. It looks kind of simplistic, but the amazing thing about this cycle here is it repeats itself in every stock, in every sector, in every index. And it's fractal, and I can find this pattern over and over again, whether I'm day trading E-minis on a tick chart or a 15 or 1 minute chart, or if I'm swing trading stocks. Now, the hard part is it's not so easy. And so often, what looks like an early sell signal, we've had 3 or 4 of these pullbacks, just as a pause to refresh and the market goes up again. So this has been a challenging market, and a lot of folks have said they've had a hard time making money, and that's because of all these pullbacks we've had, none of which amounts to much more than 3 or 4% except for a single at 7.7, but all of which start to make you nervous to be overly long, and for many folks it's dampened their returns. The old adage of don't fight the trend is meaningful. If we look at that upper left-hand corner, where is it that you want to short in an uptrend? Well, the only place you can make money shorting would be on the pullbacks. I may be at the market now all day long. I can't find those, and they're gone so quickly. Why would I want to do that? I want to buy the pullbacks in an uptrending market. Now, reality is a strong uptrend, and we've been through those, so a lot of us feel like we know what we're doing, but we've really just been benefiting from being in an uptrend. It didn't matter where we bought early on in an uptrend. In a downtrend, where do I buy and make money? Well, it's these little retracements, and I'm really not that good. So I want to either be out of the market, buying contra ETFs, or shorting or buying puts in a downtrend. And I want to buy it after the instrument actually runs up to resistance in a retracement. Now, we're supposed to spend a lot of time in a Darvas box and selling resistance and buying support, looking for breakouts and breakdowns. But we seem to be going up and down and not a whole lot of sideways motion of late in the indexes. And when you consider the 26, 28% we're up for the year since mid-November, there's not been a whole lot of time to go sideways. Before I jump into some of the tools, I just wanted to point out the website. And in fact, let me just open it up and make a few comments. Another website that I like, stockmarketmetro.com. So HGSI it's my favorite program. I think that's pretty clear. Anybody's been on my webinars. It is by far not my only program, and I don't think there is one program that does everything. The website is at highgrowthstock.com. A couple of key things if you're new. Free 30-day trial. They don't even ask for your credit card. There is a ton of free education on this. You have under products, you can learn about the software and what's in the software. In investing strategies, Ron Brown does an excellent, usually weekly. This is from August 9th, Friday, and we did one Thursday. He'll spend a lot of time looking at the market and how he uses HGSI to understand the market. I spend a lot of time looking at stocks, so we complement each other there. Ian Woodward has an outstanding blog, and everything I'm showing you is free. And he's talking about the Hindenburg omen that hit on 6th, I believe, which is, I think, Tuesday. We're going to talk about that in a couple of minutes. Under my name, you'll see a series of videos, and I'm going to start blogging in the market as well on the website, and those that are part of the forum will get some notice about that. And just a comment about that, and I'll talk about the community again, but there is a forum on Yahoo, and it's relatively active. I'd like to see it more active. But you know, when I see certain people, one guy's initials RM, for example, DS, DG, Ian, Ron, when they post, I pay attention because I learn a lot from that forum. I guess the other thing, and I'll mention it now and I'll come back to it later, is there is a workshop coming up in October, and I pay for this too. And I've been to them twice a year forever, at least for as long as they've been doing them. And you know, Ian is an amazing guy, but I think Ian's wife wants Ian to spend more time off the computer and at home. So I don't know how many more of these, if there'll be another live one. But the one in October is on. There's probably a few seats left. And if you ever want to go to an investment meeting that you will come home from totally beat and spent, but never so excited as you will be about trading, and you'll just be amazed at how much you learn. You get to meet and network, and you also gain pounds because it may seem expensive at $12.75, but it's a huge value, and they water you and feed you all meals except for dinner on pretty much Sunday night. So enough of that. Great program. Let's go back into my presentation. The data feed has been enhanced, and by that I mean there's been a recent architectural update. The good news is the updates are much faster, the data is much more accurate. And I use it to, for example, feed Metastock by exporting that data, and there's a lot of third-party programs that will use Metastock data. A couple of things will probably happen in the data over the next 12 months. The API will be made available to other third parties so that those who used to use Quotes Plus, which was our data vendor, and were able to use OmniBroker and other programs, will have the ability to, like we do with EdgeRater, to use HGSI data. And keep hoping that at some point before too long we'll get the ability to do some real-time updates or delayed intermarket updates. So let's go back to this little picture here, and I could stretch it out a little bit. And this is what the market looks like, and what you see running from optimism to euphoria. This is the period of greed, and then the markdown of the market, the despondency and the panic, the depression, and then the market coming back up. And that's what every market, every stock, every index and sector will cycle through. And one of the things that high growth stock investor, and when I say that, I don't mean just the stock. I mean Ian and Ron and the community have done such a great job, and it really helped me learn by coming up with a number of different indicators, which I'll talk about tonight, that really helped me understand whether we're in the mark up phase or that mark down phase. Most of these slides are from prior seminars, and I appreciate Ian letting me use the slides. One of the major reasons why I'm doing this program tonight is because I really want to help you deal with the vocabulary so that you don't get overwhelmed, because I do believe that I can do my complete top-down investing review in about an hour over the weekend, and then it takes me about 30 minutes at night during the week to weed out my portfolio and look for the next bunch of stocks. Now, I don't always limit myself to that time frame because, frankly, I like doing this. I don't play tennis like George Lee. I don't golf like most physicians. I trade, and I like to do this analysis. But I have gotten it down so that, as I'll show you, you don't have to spend your entire day in the stock market. So let's start with the first of these funny named indicators. Now, the first one's called the Hindenburg-Omen. Now, the Hindenburg-Omen is not Ian's or Ron's, but they've certainly helped teach it to us and the importance of it. So ignore everything on the chart except for the fact that this is the NYSE composite. This is March of '09 when we bottomed. Here is '08 when we were really accelerating the decline. But pay attention back here, and I'm not that fancy. I mean, I guess there's probably head and shoulders in here and the neckline, and we broke down here, we were in trouble. I'm going to look at something that I can see very easily, and that's these red lines. These red lines represent what's called the Hindenburg-Omen. And they don't fire very often. But when they fire, you need to pay attention. Now, you notice how many of them you see to the right here. None. They call a top in the market. Now, we've learned over the years that it's not a single Hindenburg-Omen that we have to have to call the top in the market, but it's rather a series of signals. You notice the series of signals 2 times at the top. One could have gone short, certainly as we broke down below here and made a lot of money in 2007 and 8. Why is this important? I use HGSI now to do a number of things, including plotting the Hindenburg-Omen. The reason for that is simple, in that it's easy, and I have it. It's not so simple or not so easily explained, but when HGSI changed from their old vendor, Quotes Plus, to the bar chart, which I believe is a new vendor for the data, the components of the NYSE changed. So to get an accurate fire of the Hindenburg, you need the all NYSE, and right now the Hindenburg in the program is attached to the NYSE. So that will be fixed soon, but I can reproduce it in HGSI. So one thing I wanted just to show you is we had 2 Hindenburg show at the end of May, 1 June 19th, and we just had 2 show this week. What I told a lot of my friends is that if I get a 3rd and or a 4th next week, that it's time for me to think about enjoying being retired and getting out of the market, or at least going short. By itself, it doesn't mean the end is near. Think of the Hindenburg omen as signaling those times in the market when the pros are saying, I'm getting out, and the amateurs like us are buying their stock. So they're selling to us as they're getting out of the market. In the last 25 years, every major correction has had an associated Hindenburg omen signal, but not all Hindenburg omens signify a big correction. So I see 2 in a week, enough for me to be concerned and to watch, and something that I will be paying attention to this week. And I suspect that Ian tomorrow will have a new blog talking about the 2nd Hindenburg and what that means. Now, you may have seen in these charts these gray lines. And this is an indicator, I have to admit it's not one that I use that frequently, but this is an indicator that we tried in HGSI world, and Ian and Ron doing most of the work, if not all the work here, to find an indicator, and you could see what makes up this indicator, that demonstrates that the market is at that, we're throwing out the babies with the bathwater period of time. So when we see the bingos, it tells us that the market is horribly oversold. The problem is it continued to get more and more oversold. So we started looking for the bingos followed by what O'Neill refers to as a follow-through day, and what we have come up with an objective, or Ian and Ron have come up with an objective tool called the Eureka. And in this line here, the greens represent Eurekas and the reds represent Phoenixes. They're calculated only on the NYSE, so if they're plotted on a chart, they also they give you a sense of the market, not your stock. And what we saw was that after these early bingos, there were sporadic Eurekas. In fact, one could argue that these Eurekas after the bingo signified that there was a low, and you had a pretty substantial run up here. After these bingos, you had a couple of Eurekas fire, and they fired with little run-ups of the market. But what was most impressive, if I fast forward it, in 2009, was the abundance of Eurekas occurring almost every day here. Now, we also saw a ton of them between October and March, and I think it was pretty clear that the stock market was bouncing along the bottom, and it was the changes of March 9th, the candlesticks, the volume, the clear momentum shifts, the kahunas, which we'll talk about, that demonstrated the change. So if I look at bingos as identifying periods of time when that stock is being crushed, and then I look for those Eurekas and Phoenixes to signify strength in the market. So I could see a bingo in this case on the NYSE, but I also see bingos on individual stocks. So here's what's in a bingo. And I mentioned the Eureka and the Phoenix. If you read O'Neill's books, if you read Investors Business Daily, O'Neill defines what a follow-through day is. And after he's had a up move in the market, within the next few days to week, he's looking for a day that has more volume and a big up move that sort of reinforces that there's a change in the market. Ron and Ian and the HGSI community came up with the Eureka indicator to be our objective, painted on the chart, indicator that demonstrates the follow-through day in our vernacular, an exuberance day. Now, seeing Eurekas at the end of a long market run to the upside also may signify excessive exuberance or a top. The contra to the Eureka is the Phoenix, which represents a exuberance to the downside. The next indicator that I talk about a lot is called the kahuna. Now, the kahuna lives on the next volume window. And the kahunas come in blue and red. A blue kahuna is positive, a deep blue is more positive, a light red and then a deep red are progressively worse to the downside. What the kahuna measures is the percentage movement of an instrument within its Bollinger Bands on a given day. And why is that important? Because Ian, through his research, identified that it is rare for a stock to move 24% of the movement. So by itself, that's an indicator, to me, of momentum and change coming into that instrument. And a movement of 40% is a stand up and notice day. I've also learned over the years that on a stock that's doing nothing, or seems to be doing nothing, that has 2 or 3 kahunas in a row, that stock's about to take off. So kahunas, to me, to the long side, are great indicators of increasing bullish sentiment on my instrument, while kahunas to the downside equally to the negative. Now, something else happened in Ian's use of Bollinger Bands and percent B. Percent B is the percentage between the top and the bottom with 0 to 100% or 0 to 1. If you look at a stock, if I tell you that percent B is, or you tell me percent B is 0.5, I know that that stock closed at the middle of its Bollinger Band. If you tell me percent B is 0.97, I know it closed at the top of the Bollinger Band. And if you tell me it's at 0, it's at the bottom of the Bollinger Band. I know that the Bollinger Bands represent, I believe, 2 standard deviations, so that 95% of the time, the stock price should be living between the upper and lower Bollinger Band. And if we reach periods of time when there's a high percentage of stocks above the bands, then that market's going to correct and that stock's going to move back into the bands. If there's a high percentage of stocks below the lower Bollinger Band, the market's going to correct to the upside and those stocks will move back in within their bands. It's just the law of the averages. In fact, one of the neat things with EdgeRater is this thing called the buckets report. And I just hit that little run button, and what I get is a picture. Let me show you what this picture means to me. I'm looking at the S&P 1500. I'm a little bit out of date. There's 1,495 still trading. And what this shows me, this is like the shootout at the corral, because this shows me indecision. It shows me that half the stocks are below the midline and half the stocks are above the midline, kind of middle of the road there. It also shows me that I've got a little bit heavier weighted up here, but really the stocks are spread out kind of like goalposts for a football game, which I guess is apropos because exhibition football started this week. And I've got very few stocks above or below the upper and lower band. This is a very non-extended picture. And I'll show you tomorrow, when I look back over the last couple of weeks, that one argument could be made that I shouldn't be so bearish, that the exuberance that the market was showing as little as a week or 10 days ago has abated just by internal rotation and not by any sharp pullbacks. But just by looking at this picture, I look for 80% and above in a very bullish market in the green, 80% or above in the red on a bearish market, and I watch the movement of the stocks and buckets to below in a bearish or above in a bullish market. All right. If my if folklore is correct, Ian Woodward at lunch with John Bollinger, which was arranged when one of the community members actually won it in an auction, was able to give John Bollinger education of how to use the Bollinger Bands. And subsequently, John changed a lot of his plugins on the various programs to incorporate Ian's findings. I mentioned Alexander Elder, and I'm a big fan of Elder. Philosophy, how he looks at things, MACD divergences, money management, and the force index. The force index is another momentum indicator. Now, the force index is calculated by looking at today's volume times today's close minus yesterday's close. So two things drive the force: change in price and volume. The force is plotted on a daily basis, and then traditionally what most people use is either the 2-day exponential moving average or the 13-day exponential moving average. Now, on anything that I use as a momentum indicator that has a long and a short, I look for in an uptrend for the long to be positive, and I look for in the shorter one to turn negative, which would indicate to me a pullback in a rising market. So John Sarkett, who's interpreted some of Elder's rules, talks about buying when the 2-day force turns negative in an uptrend. So that would mean the 13-day is positive. We also recognize in HGSI that if you want to know what's moving now, look at the 2-day force. And we actually stratify industries by that 2-day force, EMA of the force index, to get an understanding of what's moving at a given time. Now, one thing to be aware of is those entities like banks that have whopper volumes, JP Morgan, Bank of America, Citi, ING, will always be at the top of the force, up or down, purely based upon their volume. And whether they're positive or negative depends upon whether they made money or lost money that day. Another momentum indicator, which frankly behaves very much like the Elder as far as long and short intervals, a weekly and a daily, is the bongo. And I was involved in creating the bongo. A group of us got together, tried to figure out corollaries of the Eurekas and Phoenixes on individual stocks, and could we come up with market timing signals? Now, you can see what makes them up. They're very simple. The bongos become positive the first day that both the close is above the 9 smoothing average, and the Wilder RSI is the 8 is above the 14, above the 19, and it stays positive until it flips both below. We calculate daily, weekly. You can do it hourly. It's fractal. It's a little slow for my taste for a timing signal from the bongo weekly perspective, and probably too fast from a daily perspective. But if you are concerned about not going in too early or leaving too early, and you want to capture most of the swing without having a big drawdown, then the weekly bongo is a good trading signal. And I know one fund manager who has a nice blog that actually heavily relies upon the bongo as a trading signal. So when I put it all together, I get a chart that looks like this. So ignore the tsunami And this is the Bongo Weekly, the Bongo Daily. Now when you look at my charts, you're going to actually see the force. You have Bollinger Bands here, which I don't always display. You notice that when the Bongo Weekly is green, every time the daily went red was a pullback, So if I want to get into a uptrend on a stock, on a pullback on a stock that's in an uptrend, I may want to find those periods of time. And you notice that when the weekly Bongo, went red, the market was in a world of hurt. So it didn't get you out at the beginning of this, but it did alleviate most of the pain. And it got you back in, but it didn't get you in at the very bottom. So you will ride a long trend with the weekly Bongo, but it's not going to be fast. The daily Bongo, like the two-day force, is great for identifying pullbacks or retracements, but probably not so great when it comes to the idea of a timing model for ETF or stocks. At least for me, it's a little bit too fast. Down here we have the Phoenixes, the Bingos here. This is 2009, a series of Bingos. And then it was this series of Eurekas on the NYSE, perhaps even this Kahuna, that would have gotten you into the market. Now, Edoji, big bullish day here, all these Eurekas. I don't think most of us in HGSI land waited much beyond the low to jump into that market. We saw sporadic Eurekas in the market fall, and most of them came after really down days when the market bounced up a little bit. And for example, this one here is quite clear. You had a trash day and an equally positive day, a Bingo and a Eureka, and that was one of the false signals that we picked up, that if you had a horrible day, you'd expect to see a Bingo, a Eureka the next day after that Bingo, and you wouldn't act upon it. So you put it all together, and you see that Ian and Ron and a few of the rest of us have come up with a series of indicators. I'm not sure we really have a Bango, but Ian loves to do the little jig to the Bingo Bongo Bango song from the 40s. And so Bango is kind of what I would call this whole suite. But basically, we use these various indicators on stocks and sectors and markets, indices, to determine in or out. And that's what HGSI is all about. So come to the meeting in Palos Verdes, and you'll know more than I know. We supplement it with some other things that I learned from gurus. Pocket pivots. Again, you hopefully have read Morales' and Katcher's book. They sort of go under the idea that there are major pivots in the market and major buy signals, but they're looking perhaps to find something that happens quicker, something that tells them follow on when to buy, and the pocket pivots are great triggers for a buy or an additional buy. They're hard-coded into HGSI. We scan for them. We put them on our charts. And you can stop the video and read what goes into a pocket pivot. Essentially, it's driven by two things. The majority of it is volume, that if you're a pocket pivot up, then the volume today is greater than the highest negative volume in the last 10 days. Now, some folks, such as George Lee, look at pocket pivots down. I look at those as well. And then George has actually looked at the fractal benefits, and we'll look at pocket pivots on a 1 hour and a 4-hour chart. Viable gap ups, again, a Morales and Katcher specialty. If you look at this, every day in the market there's 10 or 15 stocks that gap up. Now, I grew up in the land of, well, they fill their gap, Jeff, so you don't want to buy them until they pull back. Except today, in our current world of momentum, that's not what I see. They keep going up and up and up. So the Morales and Katcher Bible gap ups define a BGU. And in their book, they talk about their performance, how well they've done, and their rules for selling. So buying a gap up, especially one on big volume, can be a very prudent thing, a profitable thing for your portfolio. Something that Ian probably should publish, because I think it's perhaps his simplest, but his greatest indicator is the high jump tool. I call it my own personal ATM machine, because it tells me when it's time to take my money out of the stock market. It's a simple tool. It's a number that's determined by adding three numbers together. Each of those three numbers is defined by taking the closing price and subtracting a moving average. So you closing price minus the 17 plus the closing price minus the 50 plus closing price minus the 200. You add those three together and you plot that. It's not the actual value that matters. It's how it compares to past values. When you see a stock that's the highest high jump it's been over the last several hundred trading days, there's a good chance that that stock market or index is going to drop. And I look for red candle highs at the high jump bar to find shorting or puttable positions. I look at the high jump bar before I put on a position long, and I look at the high jump bar as part of my timing. And I have programmed it, as you'll see, into various programs. Now, David Elliott, may rest in peace, was another brilliant market technician, prolific webinar hoster, and even though he's gone at www.wallstreetteachers.com, you can still pick up a lot of his videos. George Lee is a huge fan of his. I'm a fan of George Lee and friend of George. And George has really got me excited about these two things. Spring candle lows, basically you think about a stock in a downtrend. It trades below yesterday's low, but closes higher than it opened. So by definition, you have a green candle. And I believe to really be true, it's got to be at least above the midline of the prior day's candlestick. So green candle lows could be a single candle signifying a momentum or pivot or swing change. And a red candle high would be defined as a stock that opened and traded higher than yesterday close, but could not hold that and close below where it opened, creating a high bar for one that's red. So these represent the failed new lows and the failed new highs as described by David Elliott, and these are hard-coded into HGSI. The squeeze is another David Elliott. These are great setups. I'm looking for stocks that are building up some energy, but you don't know if they're going to go up or they're going to go down. And then mobile breakouts and breakdowns can be that trigger. So all of these, the handout should be distributed by George. It should be in my blog, hopefully Monday. You can program all of these things into Thinkorswim. The mobile breakouts and squeeze, I'm working with George to get them built into HGSI. Everything else that I defined tonight, including pocket pivots, Bible gap ups, green candle lows, and red candle highs, are all searchable, scannable, and chartable within HGSI. So let's talk a little bit about trading and what I do with all this. So I use words like buy list, setups, triggers, so I think I screwed them up on my webinar, so let me just tell you what I think of them. I'm looking, at the market, at the sectors. I'm trying to find the best stocks. And then I'm looking in that group of stocks to find the best setup, which to me I want to look for pullbacks in an uptrend. So that is my setup. I have other setups that I use as well, cup and handles, certain candlestick patterns such as a morning star, a hammer, especially when if it occurs, have major support. Those setup stocks go into my buy list. Now, I don't buy just because they're on my buy list, but that's what I'm going to look at during the day while I'm trading. Then I'm going to look for triggers to help me pick what and when to buy or sell. I often use multiple time frames. When I get the trigger, I make the trade. Now, a lot of what I do is end of day, so I may see that kahuna coming into the stock when the market's closed. So a lot of times I'll put a conditional trade on in the morning. Using Thinkorswim, it's quite easy, where I might say that, let's pick John Deere, because this week John Deere had a doji on Wednesday and traded up on Thursday, and I had a buy order in that basically said if it opened up above a certain amount, then I wanted to buy the stock. Now, my thought process was if the market was going to gap down, it wasn't going to trade above the high of the prior bar. And if the stock was going to drop, it probably was not going to trade above the high of the prior bar. But if it took out the high of the prior bar, although it could have been a gap and crap scenario, I had a good chance that the stock was going up. I've been able to partner with some folks that never lost trading and market gauge and others that have helped me automate these triggers and find them. So, a couple closing comments about HGSI. We've got some naming world problems. HGSI is a great software tool. But to me, HGSI is about a great software tool, the brilliant minds of Woodward and Brown, and an active community of traders. Don't miss the upcoming seminar in sunny Palos Verdes. And for those that haven't done this before, I do have a weekly market review. It's free. It's posted on YouTube. Subscribe to get notice, or you can find it at the HGSI website. And I try and do a live web conference. And then weekly, I will do a video at my convenience and post them. So you might ask yourself, why is it that I do this? Because my wife would want to know the same thing, because I don't charge for it, and I don't get paid for doing it, and I don't sell anything while I'm doing it. I do it because it forces me to follow a routine. It forces me to learn. It gives me great understanding of what the market's doing because I have to be prepared to present. And I just find it fun. Parting message, be your own guru. Investing is a business. Make sure you have the right employees, including tools and software. Continuing education matters, like the meeting in PV. Trade the market we have, not the one you think we should have. So I just want to point out a couple of the highlights of the things that I mentioned, and then I'm going to sign off and look forward to doing this, my regular call tomorrow. I can't remember what time I started. My phone says I've gone about an hour and 6 minutes. So I think what I'll do is just point out a couple of things that I've done, and we'll say good night. Yes, you can see I have quite a few programs. Actually, I think at an hour and 6 minutes, maybe the best part of Valor is to say good night. And I will put in HGSI doesn't look like much. And if I ever was financially involved in the program, I'd want to change the splash page. But I'll tell you that this little bar here is the most powerful toolbar that you'll find on any trading tool. And I'm just going to give you an example of how easy it is and quick to find some great stocks. I mentioned that I believe you can do this in as little as 30 minutes a day. I'll show you 2 tricks, and then I'm going to say goodnight, that will bring the best stocks in the market up to you without you doing anything. So the first thing I'm going to do is go to All Securities, and then I'm going to go into something up here. So you have HGSI Strategies, Woodward & Brown Top-Down Investing, Archive, Reference Library, go down to Miscellaneous, I've just taken the nearly 800 stocks and found 65 stocks that are in this Sprinter one-step bongo. And this is an old view, a view being a combination of a filter. So the filter is finding for me high relative strength, bongo dailies, yes, accumulation A or B, group rank 80%, and earnings per share rank 60. So that, I often will look at things that are higher, but 60 is going to include stocks that have had recent pullbacks, or not pullbacks, but what's what I'm thinking of? Missed earnings or drop in earnings. Now I might go in here and say, and price, we'll go to last close, is greater than, say, $5, and look at volume, 50-day moving average of volume is that's what I want. Let me look at, I want to go average volume over 50 days is greater than 150,000. Now I'm going to hit OK. I'm going to call this bongo price vol. I'm going to hit OK. OK. So I've now dropped it down to 43 stocks. I guarantee that if you look at these 43 stocks and look at nothing else, and you trade the stocks that meet these criteria, you will make money. Let's just look at a couple of these stocks that came to the top, and I'll point out some of those indicators. So very quickly, I don't know if you can see it flashing, so let me just do this. Top 2 lines are the bongos. Remember, green is top one's weekly, the second one is daily. I get pullbacks when the weekly is green and the daily goes to red. The next one is accumulation distribution, and I have the 13-day and the 2-day force. Here is the high jump bar. Remember I said when it gets to the highest high jump bar, stocks pull back? We're at the highest high jump bar on price line, so one would expect sideways action or a pullback. The reds and the green are signals of a green candle low and a red candle high, so it's automated for you. Viable gap ups show up on the next bar, and then this is looking at DMI crossovers. In this bar here, I've got pocket pivots up in blue, pocket pivots down in magenta, 2 volume bars because sometimes they're hard to see. These are the phoenixes in red and the eurekas in green and the kahunas in blue and red. And what do I see on price line? I'm a little nervous because it's extended, but sometimes big winners just keep getting more extended. Pocket pivots 2 days in a row. You could have bought it the day before, gapped up, viable gap up on Friday. A lot of price targets about 1,100. A big kahuna, everything is green. A very bullish chart, probably a little bit extended. The next one was Valiant. I love this stock. It's one of my current holdings. This is what I want. Lower left, upper right, bunch of pocket pivots coming in. Everything is green. I'll probably talk about this tomorrow or Tuesday. It's a big pharma stock that keeps making acquisitions, that's actually growing its earnings, and trades at a discount multiple to its growth rate. TripAdvisor had great earnings this past week, and you can see it's up around the high jump. If I go back and I look at Valiant, a much more orderly increase and a lot more room on the high jump to go up. TripAdvisor, big run, probably getting extended, and a doji up here. I'd like to see what it does on Monday. Don't know anything about EPAM systems, but this is one of those stocks that I find interesting. Now, I probably do a little research, see it's growing its revenue. I'd like to know what it's doing on its earnings. It is a information technology company. Cloud-based companies are on fire, so I don't know if that's one of these. Trades at a multiple of 25. Market cap is only $1.5 billion. It's kind of small. It has an average volume of 342,000, not a lot of volume. But what do I see here? A stock that was basing here, series of pocket pivots, a kahuna at the beginning of the month, another big kahuna on Friday, tons of volume. The stock's going to run. This is the kind of stock that I think I got to learn more about it. I don't love the earnings per share growth. MarketSmith isn't working tonight, or else I go in there and see. But I think that's a beautiful chart pattern and one that looks like it wants to run, assuming the market stays strong. Mylan, a generics provider, looks like it's going to stub its earnings toes in 2 quarters. But again, lower left, upper right, kind of extended. I'd probably pass on that one. Caesars Entertainment, I bought this stock on Thursday. Why did I buy it? That's sort of a cup, a handle. It broke out, pulled back into the support area, and then I saw the kahuna on Thursday, a viable gap up. I did not buy on that. Everything turned green on Thursday. Don't love the earnings per share. Don't understand why the stock has had a nice run with losing money. But I bought the pattern. Now it's easy. I set my stop below the low now on Thursday. I'm not risking much. Caesar is not at the top of its high jump. Now sometimes you just get lucky. I bought this stock. Where did I buy this stock? I bought $16 calls after this Bible gap up here. And I've been in, so my calls are August calls. They were cheap. And I've been holding the calls because this really has not violated the 50-day moving average. It's had a series of kahunas, and it broke out Friday, and I've got a big win on my $16 calls because I got a bunch of them. I wouldn't buy, it's a viable gap up, so you can follow morales and catch the rules. The stock had bad earnings and gapped up like this. And this is a stock that I'm probably going to be getting out of. But, pull back to the 50, pocket pivot up, viable gap up. I'm going to set my stop up in this area and take a look at what it does and raise my stop pretty quickly if the stock can get out if the stock doesn't continue up. Tesla, viable gap up on Thursday, leader in this market. Now, I didn't buy it here. I should have bought it here. A kahuna coming on down here with a viable gap up, and we're all thinking at $65 the stock is too high, and now it's $150. So the point here is that I use all these things. I use the bondos and the force. I use my high jump bar, my viable gap ups, my red candle low highs, green candle lows, DI crossovers. This is an 8-day exponential, 1715 at 200, simple moving average, candlesticks, kahunas, phoenix, and I use them every day. So I spent a lot of time showing you what you can do in 5 minutes, but the 5 minutes was finding Sprinter one step with Bongo and putting your price and volume characteristics. Lastly, I do a trick called the group inclusion filter. And what I do is in HGSI, under the Spark groups are a number of pre-selected stocks that change daily. And these represent the best groups in the market, or best stocks in the market. So if you're in a lot of lists, you must be a really good stock. So I do the called group inclusion report. And I basically clear everything. And what I want to do is identify my favorite smart groups. Under Morales and Catcher, it's Bible gap ups and it's pocket pivots. And then under Woodward and Brown, I am a fan of best criteria, erg, growth, HS 100 leaders, EPS and acceleration, stocks and groups moving to the upside, top down at its easiest, and EPS. I'm going to call this AAA top 10, Saturday night, and make it into 10. I'm going to hit OK, and the program is now going to look into each of those groups and find me which groups or which stocks occur in the highest number of the groups. And so here they are. These are the top 10 stocks. Actually, it's all of them, but these are the stocks that are in most of the groups. So before I say goodnight, let's just look at them very quickly. So the sprinters took a couple of keystrokes. These also took a couple of keystrokes. Here's the top 10. Let's take off my sprinter filter. My favorite one that I use is Scorecard No Index that I just built because it doesn't allow indexes. It gives me a lot of information, and it has that $5 $150,000 built in. And take a look at these. Here's my top 10 through smart groups. So very quickly, we're going to look at them. I'll say a few words and say goodnight. Encore Capital Group looks a lot like that other little stock that had a big jump up. Pocket pivot early in the week. Big move up with a kahuna, lots of volume. Everything is green. This one was all over the place on my list. They are a finance. I'll have to read more about them. Kind of extended by high jump. Their volume is 350,000 shares. I'll look closely at it because it made a lot of my list. It's probably too extended for my taste. Valley Technologies is a leading stock. At least it's starting to go sideways here, coming off the top of the high jump bar, but still very extended. Owen Financial is one of my holdings. Not quite lower left, upper right, but this stock has had great performance since the recovery of the market. This is from May of 2012. It's a three-banger in about a year and a couple of months. Certainly something I've been happy to be in. I want to find good times to buy that. Pullbacks to the 8-day with a pocket pivot. That was an add-on buy opportunity. Everything is green there. It's a little bit up here, but if you look at the high jump, it's not extended at all. It's probably still a very viable stock. Remember I said I'm a sucker for earnings. That's why I'm in that puppy. Cons is a appliance electronics retail store. Very tight, lower left, upper right. Good earnings per share growth. I'd like to see it pull back more, but it's perhaps to pull back to the 8-day, all you're going to get certainly is a leading stock. FleetCor, I kind of look at them as Visa for trucks. They do some truck stops, some gasoline refining and marketing, and then a credit with the truckers. And certainly been a leader, gapped up here, pulled back a little bit, so sort of a flag formation. Breaks above this flag. Probably setting up for us to be another buy in here. So you've got a little flag. After a flag pull, and this stock, I think, is going to continue to go up. So that might be one. If it breaks above the top of that flag, and I didn't draw that perfectly, So I'm trying to do this quickly and say good night. Here is Noah Holdings. I think these are the bagel guys. This has been making my chart for, actually no, these are banks. My bad. Chinese banks. So the Chinese stocks have been on fire. Pull back to the 50. This was a time that I started looking at it. I should have bought it there with a big kahuna off of a squeeze here. There's a mobile breakout there as well. Huge volume, Bible gap up on Friday. Might be something that's still potentially viable. One of my favorite stocks is Santeris. So many of these stocks, I commented that they're already getting extended. I've been in Santeris since about the beginning of February. And if you look back on the map here, I should have been in it a long time before that, a year ago February. And I kept saying it's extended, it's extended, it's extended. And finally I said, I'm just going to get on board and see what I can do. And it's just been a steady run. I got on board after some pocket pivot in here as a follow-through buy-on, and it hasn't looked back. And it's got great earnings per share growth. I think the stock keeps moving. Got some room on the high jump bar. Acadia Healthcare, another lower left, upper right. Looks like it's making some money. I believe it's a nursing home or skilled infusion center company, behavioral health company. Don't know much about them. Here's what I want to buy when it pulls back to the 50. Pocket pivot tomorrow, Bible gap up, might be a follow-through buy-on day. The index, Russian, Google, and it's been showing up on our scans and discussions on our weekly calls for weeks, and you can see it's in a nice move. The point of the last exercise was simple. AFOP, I skipped that one, my bad. I actually got into this one last week on the pullback here. It's a fiber optic player with huge earnings per share growth, trades at a pretty big multiple of 29, has a 300,000 average share volume. It's a young stock. Better time to have bought was the kahuna down here, the kahuna down here. You could see when it got up in the high jump, it's gone sideways and pulled back some. I'm looking for this one to give me something this week. So, 2 quick tricks, sprinters, GIF, enough basic education. Tomorrow I'll take a look at the market we have today, and then Tuesday I'll come in the market at the end of the day, show you how I integrate Thinkorswim, TradeStation, and HGSI during the day on stocks, and answer any questions you have. Let me just leave you with one final comment and reminder. I am not dumping the market yet, but I have a heightened fear that this market is becoming high risk. Now, the 2 signals here turned out to not be positive. We didn't get a third for a month. This may just be a short-term bump, and we continue to roll, but I'm going to be closely looking this week for more edge raters. Every time I said buy, I meant they were setting up. I've got to see what the market's doing in a specific sector before I make a buy. I look for my triggers. Right now I'm worried about the market, but sometimes the market climbs a wall worry. You all have a great Saturday night, what's left of it, and a Sunday, and I'll look forward to talking with many of you on Tuesday. Good night, everybody.